Hello everyone, I'm Annie and today is November 15th. Last night, the US released the latest consumer price index for October. Captain A. Vincent shared its insight, and let's dive in together. CPI is crucial as it influences whether the US will raise interest rates. The announced figures were below market expectations, indicating that inflation in the US is under control. To some extent, they suggested that the US has completed its interest rate hiking cycle. This move is a relief for many around the world. The US dollar serves as the world's reserve currency. If US interest rates remain high, it could potentially drain liquidity globally. Over the past year, many economies worldwide faced challenges, partly due to the continuous interest rate hikes in the US, exacerbating the difficulty. Some may question that USCPI was unstable. US may increase interest rate again when CPI rebound, just like the situation in March or April this year. However, the possibility of a repeat scenario may be lower this time, according to Vincent. Two key reasons contribute to this. Firstly, there is an improvement in U.S. China relations. Vincent has emphasized that China, as the world's factory, produces about 24% of global goods, but consumes only around 15%. The remaining 10% needs to be exported. If U.S.-China relations worsen, and the U.S. stops importing from China, creating a shortage, local price will rise, leading to inflation. Thus, the recent improvement in relations between the two countries is positive for the global economy. Secondly, both China and the US are inclined toward creating a mutually beneficial situation. Some US importers, due to geopolitical reasons, avoid goods produced in China and turn to products from Mexico, Vietnam, or even India. This has contributed to inflation in the US. However, recalibrating with cheaper and high-quality Chinese goods could effectively alleviate inflation in the US and aid China's export economy, easing deflation concerns. As for the current state of US-China relations, Vincent remains cautiously optimistic. Although the situation may not fully refer to the peak levels of 2013 to 2014, while both nations are increasing high-level contacts, including China's President Xi Jinping's visit to the US, and both sides approach negotiations sincerely. Moreover, the situations in the US in the past 2 years, including last year and this year, are quite similar. Last year, the US reduced the pace of interest rate hikes, but its fiscal situation worsened. Simultaneously, due to pandemic control measures, China's economy slowed down, and the Chinese yuan reached a new low in over a decade. This year, there are signs that the US is completing an interest rate hiking cycle, but the US government's credit rating has been downgraded. Meanwhile, China is facing a real estate market bubble, leading to an economic slowdown. Additionally, the Chinese yuan is hovering around the low level seen last year. These similarities in the situations of both countries over the past 2 years compel them to undergo a process of moderation. In addition, Vincent makes a bold speculation. Firstly, the US may promise to reduce tariffs on certain Chinese exports. These tariffs were imposed during the Trump administration but have not been implemented due to domestic political issues. Reducing tariffs would benefit the US by alleviating inflation. Secondly, the US may verbally commit to temporarily refrain from exporting weapons to Taiwan. This gesture will ease geopolitical tensions. While the US has sold various weapons to Taiwan in recent years, there are restrictions on certain items. A verbal commitment could be a goodwill gesture to China and contribute to geopolitical easing in East Asia. Thirdly, China may agree to buy more US agricultural products as part of the exchange. In recent years, due to strained U.S. China relations, China has reduced active purchase of U.S. agriculture products. As part of an agreement, there could be an increase in the purchase of U.S. agriculture goods. Moreover, there's a possibility that China may promise not to reduce its holdings of U.S. Treasury bonds temporarily. It might even choose to increase its holdings at the right time. Currently, U.S. Treasury bonds are relatively cheap, and their price could drop further after an interest rate hike. In summary, Vincent's speculations revolved around the U.S. interest rate cycle and the evolving dynamics of U.S. and China relations. So that concludes today's information. We'll bring you more updates tomorrow. Bye!